Welcome to TalkTickers.
Good to be here.
Today, we're digging into South Plains Financial. That's ticker SPFI. We've got their Q1 2025 earnings call results.
Right.
And our goal, as always, is to sift through it all, pull out what really matters for, experienced investors looking at the bank's health and where it might be headed.
Let's jump in. Overall, South Plains put out some pretty solid numbers for Q1.
Solid. Okay. What were the highlights?
Well, deposits saw good growth. They hit $3.79 billion, which is up about $171 million.
That's quite a jump.
Yeah. And their net interest margin in IM that actually expanded went up to 3.81% from 3.75% last quarter. That's always good to see.
Definitely a key metric. What about loans?
Loan growth was decent, reached $3.08 billion.
Yeah.
That works out to about a 2.7% annualized increase.
Okay.
But maybe the biggest standout, I think, was asset quality. Big improvement there.
How so?
Their non-performing assets ratio, it dropped like a rock down to just 16 basis points.
Wow. From what?
It was 58 basis points at the end of last year. So it's significant cleanup.
That is significant. And the bottom line, earnings per share.
EPS came in at 72 cents. Now that's down from 96 in Q4.
Okay. Why the drop if other things look good?
Yeah. Important context here. There was a $1.14 per share hit after tax tied to a fair value adjustment on their mortgage servicing rights, their MSRs.
Okay. So a non-operational item pulling the headline number down a bit.
Exactly. Underlying trends look a bit stronger than that $1.72 might suggest at first glance.
Got it. So let's dig into that loan portfolio more. Total loans held for investment, you said $3.08 billion, or was that the growth figure?
The $3.88 billion was the total. The actual growth was, like I said, about 2.7% annualized. The total held for investment was actually higher. Let me check my notes. $20.8 billion total loans held for investment. Sorry, slight correction there.
$20.8 billion, right. So where did they see growth within that? And were any areas weaker?
Yeah, the growth was mainly coming from commercial owner-occupied real estate. Also, commercial goods and services loans saw a bump, but that was partly offset by a seasonal dip in ag production loans. Pretty normal for Q1, that kind of thing.
Right, seasonal factors. And the yield on those loans, did that hold up?
Pretty much, yeah. Loan yield was 6.67%, just, a tiny bit lower than the 6.69% in Q4, but basically stable.
You mentioned earlier their metro markets, Dallas, Houston, El Paso, sounded like loan volume dipped there.
That's right, yeah. Loans in those big metro areas actually decreased a bit, down to $1.04 billion.
Any reason why? Losing business.
Not necessarily losing business. It was more about timing. They had more scheduled repayments and some early payoffs than they had new loan originations during that specific quarter.
Okay, so potentially just lumpiness.
Could be. Management did say the pipeline, especially in El Paso and Houston, looks pretty strong. So maybe just a temporary dip.
And the Permian Basin, always a hot topic for Texas banks. How did they fare there?
The Permian. That was actually a really bright spot. They said it was their strongest single quarter for loan growth there since they entered the market back in 2019.
Really? What's driving that?
Seems like they're successfully bringing in, as they put it, high-quality customers, particularly in the energy service industry.
Still focused on energy services then?
Yeah, but they stressed it's about relationships with established players, and they mentioned conservative underwriting, even stress testing against, much lower oil prices. Yeah. So trying to grow carefully there.
Makes sense. What about their indirect auto portfolio? That's sometimes an area of concern for credit quality.
They touched on that. It grew a bit, up to $243 million. But they seem focused on keeping credit tight, mentioned tightening loan-to-value requirements.
And delinquencies.
Actually improved. 30-plus days past in that auto book dropped to 41 basis points. So credit quality there seems okay for now.
Okay, good. Let's shift over to the funding side. Deposits and that NIM expansion you mentioned earlier, what fueled the NIM improvement specifically?
Right, the NIM, it was mostly about lower deposit costs. Their overall cost of deposits dropped 10 basis points.
And why was that?
It mainly reflects the full impact, the sort of lagged effect of deposit rates repricing after the Fed cut short-term rates late last year. Those adjustments finally flowed through fully.
Gotcha. So costs came down. What about the deposit mix? Still a good chunk of non-interest bearing.
Yeah, pretty healthy. Non-interest bearing deposits were about 25.5% of the total. Stable, reliable funding.
And you mentioned a big inflow earlier.
Right. They had a significant inflow of public funds, municipal deposits during Q1. That definitely helped the headline deposit growth number.
But is that sticky?
Probably not all of it. Management flagged that they expect some of those public funds to flow back out in Q2, likely due to seasonal things like tax payments. So expect some potential moderation in deposit levels next quarter.
Okay, something to watch. Now, back to that asset quality improvement. That drop in non-performing assets was really stark. What exactly happened?
The main event was a specific loan, a $19 million multifamily property loan in Houston. It had been non-accrual, but it returned to accrual status during the quarter.
Ah, so just one large resolution drove most of it.
It was the primary driver, yes. And even better, they mentioned the loan was actually fully repaid after the quarter ended, so it's completely off the books now.
That definitely cleans things up. And their overall loan loss allowance.
The allowance for credit losses stood at 1.40% of total loans held for investment. Seems adequate.
Did they need to provision much this quarter?
They took a small provision, about $420,000. They said that was mainly for some net charge-off activity and just covering the general loan growth, but it's partly offset by that overall improvement in credit quality we just talked about.
Right. And capital levels still strong.
Very strong. Common Equity Tier 1 ratio was 13.59%. Tier 1 leverage was 12.04%. So they've got plenty of capital cushion.
Which gives them flexibility. Did they use any of that flexibility for buybacks or dividends?
They did. On the buyback front, they spent $8.3 million repurchasing about 250,000 shares.
Still have authorization left.
Yeah, about $7 million remaining under the current program. And they declared their regular quarterly dividend, 0.15 cents per share. That's 24 quarters in a row now.
Consistent returns to shareholders. Okay, let's quickly touch on the other income and expense lines. Non-interest income looked a bit lower.
It was down, yeah. $10.6 million compared to $13.3 million in Q4. The main culprit there was lower mortgage banking revenue.
Why was that down? Market slowing.
It was mostly that fair value adjustment on the mortgage servicing rights. The MSRs that we mentioned impacted EPS earlier. That flowed through here.
Right, the MSR adjustment again.
Interestingly, though, even with that dip, they mentioned they've been selectively adding mortgage staff.
Oh. Betting on a rebound.
Seems like it. Positioning for a potential housing market recovery down the road. Right. Maybe trying to capture more fee income there.
Okay. And expenses. Non-interest expense ticked up.
It did. Came in at $33.0 million, up from $29.9 million in Q4. Management basically guided that this $33 million level is probably a decent run rate to expect for the rest of the year.
So higher expenses baked in going forward. All right, looking ahead then. What was management's overall tone for the rest of 2025? Optimistic. Cautious.
I'd say leaning more towards cautious. They revised their loan growth expectations for the full year.
Downwards.
Yeah, they're now guiding towards the lower end of their previous low to mid single-digit range.
And the reason? Just general uncertainty.
Pretty much. They specifically mentioned economic uncertainty and, interestingly, called out the potential impact of the new tariff announcements.
Tariffs impacting a Texas bank. How so?
Well, they feel somewhat insulated because their focus is more on commercial real estate rather than, say, C&I lending tied directly to manufacturing that might feel tariffs more immediately. But still, it adds to the overall economic fog.
Right, creates caution across the board. So focus is on organic growth for now. M&A off the table.
Focus is definitely organic, hiring lenders selectively, using their strong capital and liquidity. They did comment that M&A in the community bank space is pretty quiet right now because of all this uncertainty.
But maybe opportunities later.
Potentially. They hinted that if there's a prolonged downturn, that could shake things loose and maybe create more M&A possibilities down the line. Yeah. They seem positioned to look if that happens.
Okay, so pulling it all together for investors listening in, what are the key takeaways here?
Well, first, you got to look past that headline EPS drop. Understand the MSR adjustment impact and focus on the underlying profitability, which benefited from that NIM expansion.
Right. Core performance versus one-offs.
Exactly. Second, the cautious loan growth outlook is important. Even with the Permian strength, they're signaling some broader economic concerns in their Texas markets. So maybe temper expectations there.
Makes sense.
Third, the asset quality improvement is a definite positive. Strong capital, too. That suggests good risk management, which is crucial in uncertain times like these.
Definitely reassuring.
Fourth, the continued buybacks and dividends show management confidence and commitment to returning capital. Always a good sign.
And fun.
That strategic hiring in mortgage. It's a bit of a long-term bet, but it signals they're looking beyond the current environment for potential future growth in non-interest income if the housing market turns.
Okay, great summary. Now, for the part everyone waits for, our this is not financial advice segment. Got any outrageous but plausible trade ideas based on this call?
All right, here's one idea. Given SPFI's strong capital and that hint about maybe being opportunistic later,
Yeah.
consider a pair trade. Go long South Plains Financial, SPFI, and short a regional bank ETF, maybe something like KRE, or one more heavily weighted to C&I lending, or regions potentially more vulnerable to those tariffs we talked about.
Okay, what's the logic? A relative value play.
Exactly. The idea is SPFI's conservative approach, its Texas CRE focus, and strong capital might help it outperform peers facing potentially stronger headwinds from tariffs or other economic issues.
Yeah.
You're betting on divergence within the sector.
Interesting. Relative strength based on their specific profile. Got another one.
Okay, maybe something shorter term, more tactical. We know they expect some of those public funds deposits to potentially flow out in Q2.
Right.
But they're also still actively buying back stock. So maybe consider a short-term long position in SPFI leading into the next earnings release.
Betting that the market overlooks the deposit seasonality?
Kind of. Betting that the positive impact of continued share buybacks and the underlying strength in core things like INM will outweigh any temporary concern about deposit fluctuations in the market's perception. It's a bet on positive sentiment drivers winning out in the short term.
A tactical play on buybacks and core strength versus temporary flows. Got it. Both definitely fit the outrageous but plausible bill.
Always plausible.
All right, that wraps up our deep dive into the South Plains Financial Q1 2025 earnings call. We've covered the results, the management outlook, the context.
And just a reminder, those trade ideas, purely informational for entertainment, not actual financial advice. Please always do your own homework before making any investment decisions.
Absolutely critical. So what stood out most to you from this call? Any surprises, or does it fit the pattern you're seeing elsewhere?
We'd love to hear your thoughts too. Join us again next time on TalkTickers. We'll be tearing apart another earnings call.
Thanks for tuning in to this deep dive.